Capital gains tax. Just hearing the name can make some people break out in a cold sweat. It's one of those things like root canals or jury duty that most of us try to avoid thinking about. But here's the thing. A lot of what people they know about capital gains tax is just plain wrong. One big myth is that capital gains tax applies to everything you sell. Sold your old sneakers online, capital gains tax. Got rid of that rusty bike at a garage sale, capital gains tax. But that's about as accurate as saying every sandwich is a Big Mac. The truth is, capital gains tax only applies to profits made from selling certain assets like stocks or real estate that have appreciated in value. Another common misconception is that the capital gains tax rate is sky high, like some kind of financial boogeyman designed to steal all your hard-earned money. While it's true that nobody paying taxes, the reality is that capital gains tax rates are often lower than ordinary income tax rates. We'll delve into the specifics later, but the point is, don't let fear and misinformation cloud your judgment. The truth is, understanding capital gains tax doesn't require a PhD in economics. By busting these common myths, we can start to see capital gains tax for what it is, a complex but manageable part of our financial system. So, let's ditch the fear-mongering and dive into the facts, shall we? Okay, so we've cleared up some of the basic misconceptions. Now let's talk about how capital gains tax rates are actually determined. It's not as simple as a one-size-fits-all situation. There are different rates depending on two main factors: your income and how long you've held the asset. Think of it like ordering a pizza. You've got your income, which is like the size of the pizza, small, medium, or large. And then you've got your holding period, which is like the toppings. The longer you hold the asset, the more topping options you get. For short-term capital gains, meaning you held the asset for 1 year or less, the tax rate is the same as your ordinary income tax bracket. So, if you're in the 22% tax bracket, for example, you'll pay 22% on your short-term capital gains. Long-term capital gains, on the other hand, get a more favorable rate. These are assets you've held for more than a year. The rates are typically 0%, 15%, or 20% depending on your income level. So even if you're in a high-income bracket, you might pay a lower tax rate on your long-term capital gains than you would on your regular income. It's important to note that these are just the federal capital gains tax rates. Some states also have their own capital gains taxes, which can add another layer of complexity. But even with these variations, the basic principle remains the same. Holding assets for the long term can lead to significant tax advantages. Now let's address the elephant in the room, the argument often touted by opponents of capital gains tax, that it's bad for the economy and hurts government revenue. The logic goes something like this. If people have to pay less in taxes, the government will have less money to spend on important things like infrastructure, education, and healthcare. Sounds scary, right? But hold on a minute. This argument ignores a fundamental principle of economics: incentives. When people are incentivized to invest, it can actually lead to economic growth, which in turn can generate tax revenue for the government. Think of it this way. Imagine you're a baker. You love baking, and you're really good at it, but you also need to make a living. If the government tells you that they're going to take a huge chunk of your profits every time you sell a cake, you might start thinking twice about baking so many cakes. You might even decide to bake less, or maybe even get out of the baking business altogether. On the other hand, if the government says, hey, we want to encourage you to bake more cakes because it's good for the economy, so we're going to give you a tax break on your baking profits. Well, suddenly, you're a lot more motivated to bake. You might even hire more bakers, expand your bakery, and sell even more cakes. The same principle applies to capital gains tax. When investors are confident that they'll be able to keep a larger portion of their profits, they're more likely to invest in businesses, real estate, and other assets. This investment can lead to job creation, innovation, and economic growth, which ultimately benefits everyone, including the government. The investment game: how capital gains tax changes the rules. Let's be real, nobody likes paying taxes. It's like going to the dentist, a necessary evil. But when it comes to investing, capital gains tax plays a crucial role in shaping investment decisions. Think of it as a factor in the game of investment strategy, influencing how long investors hold onto their assets and what kind of returns they're seeking. For starters, The preferential rates for long-term capital gains encourage investors to adopt a long-term perspective, knowing they'll be rewarded with lower tax rates if they hold on to their investments for more than a year. Investors are less likely to engage in short-term speculation or panic selling. This long-term approach is generally considered healthier for the overall market, promoting stability and reducing volatility. However, it's not as simple as just holding on to everything forever. Investors also have to consider their individual financial goals and risk tolerance. For example, someone saving for retirement might be more likely to hold on to investments for the long term, while someone saving for a down payment on a house might need to access their capital gains sooner. The bottom line is that capital gains tax isn't just about collecting revenue, it's about influencing behavior. By incentivizing long-term investment, policymakers aim to create a more stable and prosperous economy for everyone. Policy tweaks, big impacts, how governments can influence investment. Now imagine capital gains tax as a set of dials and knobs that governments can adjust to fine-tune the economy. By tweaking rates and making other policy changes, governments can encourage or discourage certain types of investments, influencing how capital flows within their countries. For example, a government might choose to lower capital gains tax rates to stimulate investment in a particular sector, like renewable energy or affordable housing. This can make these investments more attractive to investors, driving capital towards projects that align with broader societal goals. Conversely, a government might decide to raise capital gains tax rates to curb excessive speculation in certain markets, such as real estate or luxury goods. This can help cool down overheated markets, prevent asset bubbles, and promote more sustainable economic growth. Of course, changing capital gains tax policy isn't as simple as flipping a switch. Governments have to carefully consider the potential consequences of their actions, weighing the benefits of increased revenue against the potential impact on investment and economic growth. It's a delicate balancing act, with no easy answers. Real-world stories, capital gains tax in action. Let's take a look at some real-world examples to see how capital gains tax plays out in practice. Imagine a young entrepreneur named Sarah who starts a tech company in her garage. She pours her heart and soul into her business, working tirelessly to develop a groundbreaking new product. After years of hard work and dedication, Sarah's company takes off. Investors are clamoring to get a piece of the action, and her company goes public. As a result, Sarah's shares in the company, which she initially purchased for a relatively small amount, are now worth millions of dollars. When Sarah decides to sell some of her shares to fund the company's expansion and secure her financial future, she'll be subject to capital gains tax on the profit she made from the sale. However, because she held on to her shares for the long term, she'll benefit from the lower long-term capital gains tax rates. Now, let's consider another scenario. Imagine a real estate investor named David who buys a run-down apartment building in a rapidly gentrifying neighborhood. He renovates the building, raises rents, and sells it a few years later for a significant profit. David's profit from the sale of the building will be subject to capital gains tax. However, because he held the property for a shorter period, he'll likely pay a higher tax rate than Sarah did on her long-term stock holdings. These examples illustrate how capital gains tax can impact real people's lives and financial decisions. Understanding the rules and nuances of capital gains tax is essential for anyone looking to make informed investment decisions and plan for their financial future. The bottom line: capital gains tax and you. So, we've explored the labyrinthine world of capital gains tax, debunked some persistent myths, and even met some folks navigating its intricacies. But what does it all mean for you? First off, don't be scared. Capital gains tax is just one piece of the financial puzzle, not some monstrous beast lurking under your bed. By understanding the basics, how it's calculated, the difference between short-term and long-term gains, and its potential impact on your investments, you can make informed decisions that align with your financial goals. Secondly, remember that knowledge is power. Don't rely on hearsay or assumptions. Take the time to research and understand the specific capital gains tax laws in your jurisdiction. Consult with a qualified financial advisor who can provide personalized guidance based on your individual circumstances. Finally, don't let fear or misinformation paralyze you. Capital gains tax, like any tax, is simply the price we pay for living in a functioning society. By approaching it with a clear understanding and a proactive mindset, you can navigate the system effectively, and achieve your financial aspirations. Stay informed, stay engaged, and remember, knowledge is your most valuable asset.